Hey guys, Dave Keller here with Market Misbehavior. Thanks for watching my video today. I'm often asked about the price of gold and what my expectations are and what the technical picture for gold, how it looks. It's interesting. Gold sort of comes in and out of favor in a big way. People either think it's the most amazing thing ever, that it's so important for investors to at least own some of in a portfolio, well-diversified portfolio, or it's the worst bet ever, and why would you ever waste your time looking at something like gold? To be honest with you, the answer for most investors is probably somewhere in the middle. If you're really thinking about diversifying what you're doing across different asset classes, having some exposure to commodities probably makes sense, and something like gold is important. The main reason is because it has a very different return profile than stocks, right? If you have most of your portfolio in stocks, which many investors do, having something in things like gold and real estate, alternative assets, just helps to make sure that you're not completely tied to one asset class. And if that asset class doesn't work, then you're in a lot of trouble. Challenge for gold is this: the chart does not look good. And what we're going to do today is talk about why the chart for gold remains bearish. All right, so we're going to get to the chart of gold here in a minute. Just wanted to let you know first, if you like this sort of thinking about investor decision-making, routines, charts, technical analysis, trend, momentum, breadth, sentiment, all of the above, if that's of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along this ride with us. Also, give the video a thumbs up if you appreciated it. We would very much appreciate that back. Finally, put a comment below the video. What do you think about the price of gold for the next 6 or 8 weeks? Think it's bullish or bearish, and why? Let's get to the chart. All right, so we're actually going to look at 2 charts of gold today. We're going to start with a 1-year chart of the GLD. Now, you can look at gold in a number of different ways. When I'm looking at an asset class, I usually use an ETF if at all possible. And the reason is because I've found in my work with institutional investors, we would often look at the commodities, the futures, we would look at the currencies and all of that because there would be different ways you would have exposure to those asset classes using different derivatives or different levers you could pull as an investor, or maybe you're just looking at the underlying equities and thinking about how they're affected by all of those different asset classes. I found working more and more with financial advisors and now more with individual investors that ETFs are often a relatively inexpensive and fairly liquid way that you can access some of these markets. So I tend to use ETFs as much as possible. The GLD is one that actually tracks the price of gold pretty well because the GLD is actually holds physical gold. So the GLD, when you buy it, it's actually backed up by physical gold. A lot of ETFs, a lot of commodity ETFs don't really have that. They're getting exposure using some sort of derivatives or some sort of futures or something like that. But the GLD and the price of gold are pretty spot on. I mean, they're gonna track pretty closely. So it's one of those that actually is pretty straightforward to use. So from a technical perspective, what can we learn about the price of gold and using the GLD? Well, we're going to look at this chart. I'll explain what each of these are, and we'll look at why the picture still remains very bearish. So what happened with gold over the last year is you actually had a run off the left side of the screen. There's a big run up in gold as it rotated higher. It actually had bottomed out back here earlier in the year, rotated higher in the fourth quarter, and then started to come down. And then all of a sudden we have this acceleration to the downside. So bottomed out in March of this year, popped higher. So this is actually a pretty good downtrend, and then rotated higher, made an interim peak there in May into early June. And from there, it's been in sort of this choppy sideways to down maneuver over the last 3 months or so. Just in the last couple of weeks, we've had a couple gaps lower in gold, and most recently a gap lower that was just quite unfilled. And then we have another gap down this week, and gold finishes toward the lower end of the week here as we're recording this on a Friday. So the first thing is I have this bright red colored line here, which is the 200-day moving average. And very simply, I'm just showing how the 200-day moving average has gone from sloping higher to sloping lower. And that is such a very simplistic way of looking at trend, but there's a lot of value. In general, if you could look at a bunch of things and just look at whether the 200-day moving average is sloping higher or sloping lower, that'll tell you a lot of what you need to know about which things are working and which things are not. If you take a pile of charts and just throw them on a table or put them on on your screen and just look for things where the 200-day moving average is sloping upwards and look at the things where the 200-day is sloping downwards, you will recognize why those charts look very different. And the ones where the slope is very negative tells you just the long-term trend is negative. Now, within that, you've seen a lot of bounces, a lot of upswings and downswings, and that's because a market doesn't just move from point A to point B. It sort of has an impulse and a corrective wave. An impulse wave in the direction of the trend, a corrective wave against the trend, Elliott wave, that's part of the
Elliott wave methodology that I actually find pretty meaningful. I think that actually makes a ton of sense. So number one, the moving average, long-term moving averages are sloping downwards, and the GLD right now is below 2 downward sloping moving averages, and that is not a good position for a chart to be in. The second item is looking at the RSI. This is a classic measure of momentum, and a lot of the videos I show on the channel here, we include RSI in some way. It's my favorite way of recognizing price momentum. And in general, if the RSI is at 50, the up and down days, looking back over a period of time, are relatively even. It's an equilibrium between up days and down days. If the RSI is very high, the market's probably overextended to the upside. If the RSI is very low, it's most likely overextended to the downside. You look at when it comes out of those extreme regions for an indication that we're going to potentially reverse. You saw that here in May into June when you had an overbought condition. It came out of the overbought region. We saw that here in June and also in August when you became oversold. You came out of that and soon after rotated back to the upside. So right now, 2 observations on the RSI. Number one, it is not yet oversold, meaning there could be still room to go and further downside to be had. Number two, when the RSI, when the price of gold has bounced higher in July, August, and September, look at how the RSI has never really gotten above 60. What happens with the RSI as a technical indicator is the whole range of it will fluctuate up and down depending on whether or not we're in a bullish phase or a bearish phase. In a bullish phase, the whole range will kind of bump higher and the RSI will become overbought on the upswings and will not get below 40 on a pullback. In a downtrend, the whole range goes down and you become oversold a lot of times on a downswing, and you don't get above 60 on a move back higher. If you look at what's happened, we've been oversold on the downswings. We've not gotten above 60 on the upswings, which is more classic behavior for a bearish phase, not a bullish phase. Finally, at the very bottom, I think the most damning part of this chart, or the most bearish part of this chart, is the fact that the relative strength of gold versus the S&P has gone consistently down, and that goes even further behind the left side of this chart. So overall, you just haven't gotten a lot out of gold relative to stocks, right? That's continued to go lower. So as long as that line keeps going lower, it basically tells you you're not really gaining anything on a relative basis by owning gold as opposed to owning stocks, and just finding other opportunities within the equity landscape to hold on to. So that is why the picture for gold overall is negative. And again, if you think about it, these are relatively simplistic observations. We haven't really talked about the price behavior. It's just looking at some indicators that are meant to quantify the behavior reflected on the chart, really. What we're going to do now is look at a second chart. There's a lot of lines on here, so I apologize for that. Most things that I show are relatively simplistic because I like to simplify the message, not cloud it. I promise I'll explain what everything on here represents. So don't get too nervous about what's going on here. We're looking at a little longer time frame, about just over a year and a half, and we did that to go back to March of 2020, because that's when gold actually bottomed out. That's when stocks bottomed out. A lot of things bottomed out in that sort of end of the first quarter of 2020. From there, gold actually went up in a pretty big way, and the GLD went from 136 at the lows all the way to 194 here a couple months later in August, early August. From there, we've begun sort of this downtrend. And the last chart we looked at was sort of zooming into this area here. You can see how there was a little, we had a little higher to come onto. We've continued down. So let's look just now at the price behavior and think about what it's telling us. So one of the other issues with the GLD and why I think the chart still remains very bearish is the fact that trend lines tracking the high. So in a downtrend, what you do is you will draw trend lines connecting the high. So here, if you take the August high, you connect that to the November high, you can see we broke above that trend line in December, which should be a very bullish reversal, telling you we've rotated from a downtrend to an uptrend. But if you look, it was a failed breakout. Very soon, we got below there. We did finally break above that line, that broken line here in April. But if we take another trend line and take the high from August and connect that to the high in January, we connect that here, you can see we broke out here in May. Very soon after, it was another failed breakout. What's happened in the last year and a half is you've had a series of failed breakouts. The time when gold should have continued higher. Third example, June high this year, August high of this year, we broke above it. About a week later, we rotate back down and we got right back below the trend line. So this actually, the gold has a history in the last year and a half of giving a potential buy signal, but then failed. And failed breakouts are a sign of a very dangerous market. That is a market that is more bearishly inclined because breakouts don't see it followed upside momentum, right? You don't see enough buying power to overwhelm the selling pressure and propel the chart even further to the upside. The other horizontal lines that you're seeing on here are indicating Fibonacci retracements. There are a couple things that I point out to you. If you take the low from March of 2020 and take the high from August of 2020 and connect those two, and then use Fibonacci retracements to identify the key support and resistance levels between those extremes. We have the 38.2% level around 172. We have a 50% level around 165 and 61.8% level around 158. I have other videos on my channel that dig a lot deeper into Fibonacci retracements. I'd encourage you to check those out if you don't know what I just described or if it's unfamiliar to you. Look at this particular level around 172, and you can see that there have been a lot of price sort of clusters around that price, right? We hit resistance there in May before breaking out. We bounced off of there in June before breaking down. We've now hit resistance just below that level a number of times here in July, August, and then again in early September. Now, if you do another round of Fibonacci retracements, take that high from August, connect that to the low in March, which so far has been the low in the last year. You can see we bounced higher, we traded above there, and the 38.2% level is right here, just below the 172 level. It's around 171.50 or so. We did break above it a little bit, but then came right back and traded below, and now we've bounced once again a number of times to that level. So this pink shaded area kind of combines a number of different things. It's a 38.2% retracement of the March to August run. It's a 38.2% retracement back up from the August 2020 high and the March 2021 low. And it's also the resistance that we found a number of times, July, August, and September. The reason why I'm showing that is what would cause this chart to look less bearish and more bullish. A couple different things. Number one, we would have to break that range that I just described to you. I think the most important thing the GLD could do is get above 171.50 to 172. That's this pink shaded area, and hold that. It would need to break above there and hold. If you look in May to June, we broke above it, but we didn't hold it. Within a month, we'd actually rotated right back lower and made a new swing low. We want to get above there and hold, and that would indicate enough of a rotation back to the upside, showing a rotation from excess supply to excess demand for gold. Number two, we would need to put in a higher low, and that's what we're potentially doing right here. If you think about the chart of the S&P, it's almost this flipped upside down. The S&P made a new high in early September, now potentially is making a new lower high. We'll have to see if this week's run continues and we retest the all-time highs, but if not, it's going to look like a head and shoulders top, a classic topping pattern. Here we might be actually seeing an inverted head and shoulders, which is basically a low surrounded by two higher lows. We'd have to put in a higher low, which would indicate that the price is no longer reaching the previous lows, right? A lower low, continued pattern of lower lows is what a downtrend looks like. When you stop making lower lows, that's an indication you're starting to see some demand come into the picture. So does this higher low hold? We remain above 161 on the GLD, which would be the second bullish thing I would look for. The third thing would be the RSI finally getting above 60. And that would most likely happen if the price of the GLD gets above 172. That would happen within enough of an upswing to get the RSI above 60, which would take it out of that bearish range and put it more into a bullish range. So overall, the chart to me looks bearish. Those are the three things I might look for to indicate a potential rotation from a bearish scenario to a bullish scenario.
So there we go. That's the take on gold using, again, a pure technical view. We didn't talk about things like inflation concerns, the Fed, interest rates. All of those are part of the mosaic, but the point of my channel is to help you think as much as possible about the technical configuration. I would argue a holistic investor, a well-rounded investor, should think about the charts that I just showed you, how that relates to all those other things that I just mentioned, because it's all part of the mosaic. It's all part of the picture that you're trying to understand, I hope, as an investor. Couple quick comments as a thank you. Number one, subscribe to my channel if you could. It'd be great to have you along this ride if you appreciate this sort of thinking about technical analysis and behavioral finance. Also, if you appreciated this video, give it a thumbs up if you would. We'd very much appreciate that back. Finally, put a comment below the video. Do you agree with my assessment that the chart at this point is still bearish? Do you see the chart of gold being more bullish or bearish over the next 6 to 8 weeks, and why? Let me know in the comments below. From everyone at Market Misbehavior, I'm Dave Keller. Be well, stay safe. See you again soon.